JD.com is one Michael Burry stock down 65% that I think you might regret not buying on this dip here. Of course, Michael Burry is infamous for his role in calling the housing crash in 2007 and making his investors millions of dollars in profits. And in Michael Burry's portfolio right now, he's got only 9 stocks, and JD.com is one of them at 9% of total portfolio value. The other Chinese e-commerce stock, Alibaba, is also 9.46% of his portfolio value. But I've already got a video saying that, Alibaba is a stock that you should buy. So this video is going to focus on JD.com and why I think that's a stock you might regret not buying on this dip, starting with its phenomenal revenue growth, exploding from a little under 25 billion in 2014 all the way up to 155.76 billion in its most recent year. Now, of course, its growth rate is slowing in recent quarters, but that's also contributing to rising profit margins as the company is letting go some of its less profitable segments of its business, which I think overall is good news for investors. I prefer profitable growth rather than unprofitable growth. So to let go of some of your least profitable segments, I think is overall a net positive for investors. Speaking of its profit margins, the company has not done extremely well with profit margins in terms of the overall number. But what I like to see is that upward trend. As its revenues have grown, JD.com has done a great job of increasing its profit margin, its operating profit margin, from negative 5 or 6% in 2014, now all the way up to 1.74% in its most recent trailing 12 months. And like I mentioned earlier, the shedding of its less profitable segments, as well as the sustained momentum in the economic reopening in China, should continue to propel this company's operating profit margin higher from here. So it's already demonstrated great economies in scale, and I think that will persist at least throughout 2023 because it'll catch a tailwind from the economic reopening in China. And I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. The last reason why I will give why I think that JD.com is a Michael Burry stock you might regret not buying on this dip is because of the favorable valuation. JD.com is trading at a forward price to earnings ratio of just 10.54. That's the cheapest this stock has been in about 2.5 years. Going all the way back to January of 2021, this is the cheapest this stock has been. And now you're getting it with the economic reopening of China behind it and its focus more on profitability. I think it's a good risk versus reward. Now, of course, the Chinese stocks always, well, not always, but they do come with the risk of potential delisting of their ADR shares in the US and other geopolitical risk. However, I feel that with this valuation, that risk is more than accounted for, right? You're getting this company with rising profit margins, rising revenue at a forward price to earnings of just 10.54. A comparable stock in the US would be trading at a much higher valuation. If you just look at what Amazon is trading for, what Shopify is trading for, those are selling for much higher valuations. And given it's not an apples to apples comparison, but it just goes to highlight the discounted valuation the Chinese e-commerce stocks are already trading for. And the same is true for Alibaba. And clearly, it seems like Michael Burry feels that this discount is too much, that it's overdone. And that's why I feel he's got so much of his portfolio in the Chinese e-commerce stocks 9% of his portfolio in JD.com and another 9.46% of his portfolio in Alibaba, both of which I think are buys, and I've said so in several of my videos throughout this year. And so For all those reasons, I think JD.com is one Michael Burry stock that is down 65% that you might regret not buying on this dip here. All right, so thank you so much for watching this video. I've picked this other video that I think you will enjoy, so please click on that and I will see you over there.